Tens of thousands of people who follow Warren Buffett read his annual shareholder letters with great anticipation every year, hoping to learn something new from one of the greatest investors of all time. When it comes to money matters, from the stock market to personal finances, Buffett's letters are a treasure trove of knowledge. To provide you with the most important lessons, I spent several days carefully reading through 20 of these letters. Today, I will discuss the 10 most important things that I discovered about investing from reading shareholder letters written by Warren Buffett himself. By the end of this video, you'll have actionable insights straight from Buffett that can help you start investing wisely and build substantial wealth, even if you're starting with just $1,000. Let's jump right in. Lesson number 1. Invest in quality businesses at fair prices. In his 2023 shareholder letter, Warren Buffett recounts a particularly important piece of advice he received from Charlie Munger in 1965, which shaped the investment strategy of Berkshire Hathaway. Warren, forget about ever buying another company like Berkshire. But now that you control Berkshire, add to it wonderful businesses purchased at fair prices and give up buying fair businesses at wonderful prices. In other words, abandon everything you learned from your hero Ben Graham. It works, but only when practiced at small scale. This advice marked a significant shift in Buffett's investment approach. Instead of focusing on buying undervalued businesses, as advocated by his mentor Ben Graham, Buffett, guided by Munger, began to prioritize acquiring high-quality businesses, even if it meant paying a fair price for them. The main idea of this lesson is to put long-term performance and a company's inherent quality above a short-term market discount. To understand it, imagine you're shopping for clothes. Instead of buying a cheap shirt that might wear out after a few washes, you decide to invest in a well-made, durable shirt that will last you for years. It might cost more upfront, but in the long run, it's a better investment. Similarly, when investing in stocks, look for companies with strong fundamentals and consistent performance, even if their stocks are not dirt cheap. Quality businesses tend to grow and sustain their value over time. Now, let's apply this advice to your own investing. If you have $1,000 to invest each month, focus on buying shares of well-established companies with a track record of solid performance and growth. Instead of looking for the cheapest stocks, target companies that are leaders in their industries and have strong financial health. Let's say you decide to invest your $1,000 monthly into a high-quality stock like Apple. Over time, as Apple continues to grow and generate strong earnings, the value of your investment is likely to increase. This approach follows Buffett's philosophy of adding wonderful businesses to your portfolio and holding them for the long term. By allocating your $1,000 each month into buying shares of high-quality businesses, you are setting yourself up for long-term success. Lesson number 2. The importance of patience and long-term thinking. In his 1986 shareholder letter, Warren Buffett emphasizes the importance of patience and long-term thinking in investing. Our favorite holding period is forever. This principle shows the value of holding quality investments for the long haul, rather than trying to time the market or make quick profits. Buffett's advice is rooted in the belief that the stock market rewards patience and long-term investments. Instead of getting caught up in short-term market fluctuations, successful investors should focus on the intrinsic value of their investments and allow time to work in their favor. This approach helps in mitigating risks and capitalizing on the compound growth of investments over time. Think of investing like planting a tree. You don't expect it to grow overnight. Instead, you water it, give it sunlight, and let it grow over the years. Eventually, it becomes a sturdy tree that provides shade and bears fruit. Similarly, investing requires patience and long-term perspective. By holding on to your investments, you allow them to grow and benefit from compound interest. If you have $1,000 to invest each month, focus on buying shares of strong, reliable companies and commit to holding them for the long term. Consider investing in a broad market index fund like the S&P 500. This fund includes a diverse range of large, established companies and has historically provided steady returns over the long term. By investing $1,000 each month into the S&P 500 and holding it for several decades, you can benefit from the overall growth of the market. Buffett himself has often praised the S&P 500 as a solid investment choice for most investors. Lesson number 3. Benefit from market volatility. In his 2012 shareholder letter, Warren Buffett explains how investors can benefit from market volatility. If you're going to be a net buyer of stocks in the future, either directly with your own money or indirectly through your ownership of a company that is repurchasing shares, you are hurt when stocks rise. You benefit when stocks swoon. Buffett's advice is to view market downturns as opportunities. When stock prices drop, they become more affordable, allowing investors to buy shares at lower prices. For long-term investors, falling prices present a chance to purchase quality stocks at a discount, leading to gains when the market recovers. Think of the stock market like a sale at your favorite store. When prices drop, it's a great time to buy more. Similarly, when stock prices fall, it's an opportunity to buy shares of good companies at lower prices, which can increase in value over time. During a market downturn, invest your $1,000 in reliable companies like Apple or Microsoft. By buying shares at lower prices, you gain more when the market recovers. This approach aligns with Buffett's philosophy of being a net buyer during market dips. Lesson number 4, focus on consistent, predictable earnings. In his 1996 shareholder letter, Warren Buffett emphasizes the importance of investing in businesses with consistent and predictable earnings. We like businesses with consistent and substantial profits, not those that have wild swings in profitability. Buffett's advice is to focus on companies that generate steady and reliable profits rather than those with unpredictable earnings. Consistent earnings indicate a stable and resilient business model, which is less likely to be affected by market volatility and economic downturns. This stability can lead to more reliable long-term returns. If you have $1,000 to invest each month, look for companies with a track record of stable and predictable earnings. Avoid businesses with erratic profit histories. This strategy helps ensure that your investments grow consistently and reduces the risk of sudden losses. Consider investing in companies like Procter & Gamble or Johnson & Johnson. These companies have a history of stable and predictable earnings, making them safer bets for long-term investors. By investing your $1,000 monthly in such reliable companies, you align with Buffett's strategy of focusing on consistent profitability. Lesson number 5, avoid debt and maintain cash reserves. In his 1993 shareholder letter, Warren Buffett stresses the importance of avoiding debt and maintaining significant cash reserves. We will never risk getting caught short of cash, regardless of the attractiveness of available opportunities. Think of your finances like a safety net. Having cash reserves ensures that you are protected against unexpected expenses, like car repairs or medical bills. Avoiding debt means you won't be burdened by high-interest payments that drain your resources. Before investing your $1,000 each month, ensure that you have an emergency fund covering 3 to 6 months of living expenses. This fund acts as a financial buffer, allowing you to invest without worrying about immediate cash needs. Also, avoid high-interest debt, which can erode your investment gains. Lesson number 6, take advantage of market downturns. In his 2008 shareholder letter, Warren Buffett emphasizes the importance of taking advantage of market downturns. We enjoy such price declines if we have the funds available to increase our positions. Long ago, Ben Graham taught me that price is what you pay, value is what you get. Whether we're talking about stocks or socks, I like buying quality merchandise when it is marked down. Buffett's advice is to see market downturns as buying opportunities. If you have $1,000 to invest each month, don't be afraid of market downturns. Instead, use them to your advantage. Buy more shares of strong companies at reduced prices. This strategy helps you accumulate quality assets that can provide substantial returns when the market recovers. During the 2008 financial crisis, many high-quality stocks saw significant price declines. By investing your $1,000 in reliable companies during such downturns, you can purchase more shares for the same amount of money. When the market rebounds, the value of these shares will likely increase, providing you with significant returns. Lesson number 8, the value of transparency and trust. In his 2014 shareholder letter, Warren Buffett points out the importance of transparency and building trust with his shareholders. We will never use your money recklessly or quickly. Berkshire's strength comes from its unique culture, which is built on a foundation of trust and integrity. Buffett's advice here is to prioritize honesty and transparency in all business dealings. Building trust with shareholders and maintaining a reputation for integrity are fundamental to long-term success. This principle ensures that investors feel confident and secure in their investments, knowing that their money is being managed responsibly. If you have $1,000 to invest each month, choose companies that prioritize transparency and have a reputation for integrity. Look for businesses that communicate openly with their shareholders and demonstrate a commitment to ethical practices. This approach helps you invest in companies that manage your money responsibly. Consider investing in companies like Berkshire Hathaway itself, or other businesses known for their transparency and ethical practices. These companies regularly communicate with shareholders and maintain high standards of integrity, providing a safe and trustworthy investment environment. Lesson number 9, understand the power of compounding. In his 2016 shareholder letter, Warren Buffett highlights the incredible power of compounding. The power of compounding enables you to create significant wealth by reinvesting earnings and allowing your investments to grow exponentially over time. Buffett's advice focuses on the importance of reinvesting earnings to benefit from compound growth. Compounding occurs when the earnings from your investments generate additional earnings, leading to exponential growth over time. This principle is critical for building significant wealth, especially when starting with a modest amount. Think of compounding like a snowball rolling down a hill. As it rolls, it picks up more snow and grows bigger. Similarly, when you reinvest the earnings from your investments, they generate more earnings, leading to faster and larger growth over time. If you have $1,000 to invest each month, focus on investments that allow you to reinvest your earnings, such as dividend-paying stocks or mutual funds that automatically reinvest dividends. Consider investing in a dividend reinvestment plan with a company like Coca-Cola or an index fund that automatically reinvests dividends. By reinvesting your dividends each month, your $1,000 investment can grow significantly over time, thanks to compounding. Lesson number 10, the power of index funds. In his 2019 shareholder letter, Buffett emphasizes the long-term growth potential of diversified portfolios through indexing. Let's put numbers to that claim. If my $1,114.75 had been invested in a no-fee S&P 500 index fund and all my dividends had been reinvested, my stake would have grown to a worth of $606,811 on January 31, 2019. Buffett's advice highlights the benefits of investing in index funds, which provide a simple and low-cost way to achieve diversified exposure to the stock market. By reinvesting dividends and holding the investment over the long term, investors can harness the power of compound growth. Think of an index fund like a basket that holds shares from all the big companies in the market. Instead of picking individual stocks, you invest in the entire basket. This way, even if some companies don't do well, others can balance it out, providing steady growth over time. If you have $1,000 to invest each month, consider putting it into a low-cost index fund like the S&P 500. This approach helps you spread your risk across many companies and take advantage of the overall growth of the market. It's a simple and effective way to build wealth over time. Over the years, as the companies in the index grow and pay dividends, your investment will benefit from compounding. This strategy has historically provided strong returns, as illustrated by Buffett's example of a small investment growing into a substantial amount over decades. If you're looking to turn small, consistent investments into a significant income stream, I have just the next step for you. Watch this video if you want to learn how to turn $30 a week into $6,000 monthly dividend income.